right, everyone. Shoot, what's going on here? There we go. All right. So, okay. So we're just got to the end of the week here, right? That seems like an accomplishment, right? And like I said, I hate Friday afternoon class, so we're going to try to be as efficient as possible here. get you on your way the weekend. Just be looking for that agenda email from me, right? That will have homework number 2 on it, and it will also have the readings for Monday on it, and those are the big things to be working on over the weekend and getting ready for the first exam, which is on Tuesday. Okay. So this afternoon, I wanted to just kind of talk about a few other issues related to stock markets. I want to spend a little bit of time talking about the quants, right? Quant trading, which is what your reading was about. Talk a little bit about the role of psychology in behavioral psychology and thinking about how markets work. And then spend a little bit of time talking about stock market crashes and asset bubbles, right? Why do we get big crashes, right? And so those are kind of the 3 big things that we'll talk about here this afternoon. So this, we kind of maybe classify everything here this afternoon as issues in stock markets. First, quant funds, right? You have this article to read. I won't go into all the details because you've all read this, but now these quantitative funds are doing about 1/3 of institutional trading, right? And this is growing rapidly, right? Growing very rapidly. What do quant funds do? They rely on 2 things. What are the 2 big things that quant funds are relying on? When we say quantitative trading, what are we talking about? I mean, obviously computers, but what are computers doing? Algorithms. What kind of algorithms? Yeah, it's not, I mean, really technically, it's not really even an algorithm, what they're using.
Machine learning.
Machine learning and artificial intelligence, right? And where is this learning coming from? It's based on big data. So the fact that so much information can be scraped off of the web, and then from that, you try to observe patterns, insight, make connections. So the reason why it's not an algorithm, and I'm not a computer scientist, but an algorithm is really humans telling the computers what to do. Machine learning is the computers themselves are trying to figure it out simply by crunching huge data, right? Crunching huge data. So, you know, just to give you an idea of how powerful these things are. Right now, the computer that is best at playing chess in the world is based on a machine learning diagram. And how did it learn how to play chess? It simply learned how to play chess by, in the course of about 8 hours, analyzing every chess game that it could online. And so in about 8 hours, this thing developed basically processes by which it could beat every other human or computer chess programmer or player, right? That's how powerful these things are, right? So it's not like humans telling them what to do. They're basically just learning, right? They're learning based on big data, and there's so much more data out there. There's all, you know, there's many things to learn that humans, you know, the argument is there's many things to learn that humans simply can't pick up because we really don't have the ability to analyze data in that kind of quantity, right? And so many people are arguing that this is really an extreme version of efficient markets. Because efficient markets are based on processing data and forming rational expectations. Well, computers can do, in theory, both of those things better than humans can. The other good thing is that the argument for these things is that they don't have the same biases that humans do. And we're going to talk about that in a minute. Our psychological biases are real. And they impact the way that we make investment decisions, and mostly in bad ways. And so the proponents of this argue that, you know, this is good, right? Because it basically allows people to make better decisions. Of course, there's some worries about this too, and your article talks about them. One of the worries is the possibility of herding, right? And what does herding mean? Meaning everybody tries to do the same thing at the same time. So these computers can make such quick decisions and can follow what other people are doing so quickly that there's a worry that if one of these, you know, AI machine quant funds started trading, you know, trying to sell, every other fund would see what was happening, and through machine learning, figure out, well, then I should sell too, and everybody could be selling at the same time, right? That it leads to, you know, kind of this herding behavior that would amplify such fluctuations. This actually has happened before, back in 1987, right? 1987, in October, I can't remember the exact date, there was a day in which the stock market fell by 22% in one day, okay? Way back in 1987, right? When we, you know, I had a Commodore computer, right? The 64K, right? And still, you know, still today, what drove that was that a lot of traders were actually using computers to make trades. These were computers that were much less powerful than your phones, but they were using computers to make trades. And once again, sometimes when everybody's using the same processes, you can get this herding behavior. So this is real. This is real. And, you know, I'll tell you, for me, I have my retirement funds in a 401k offered by Cornell. And Cornell is part of TIAA-CREF, which is the largest educational pension company in the world, right? So most collegiate institutions are part of TIAA-CREF. Many public schools are part of TIAA-CREF. TIAA-CREF offers you lots of different ways that you can invest your money in your 401k. TIAA-CREF now has what do they call it? The virtual portfolio manager. And so for a small amount of money, they basically will manage your portfolio day to day. And how are they making these decisions? Artificial intelligence is basically offering you the opportunity to do quant trading. And this doesn't just have to be day by day. You can also just have it balance your portfolio. So in other words, if stocks run up, you know, for a couple of months, this will automatically rebalance your portfolio so you don't get too heavy in stocks. And so no individuals are involved in managing this. This is all quantitative, right? And so that's really, in many ways, I think, the future of trading, right? Now, whether this is going to be good or bad, I think remains to be seen. There's certainly a lot of attractive things about it. But of course, one of the reasons why having machines do our trading, it's not that machines are perfect, but we know one thing, that humans are really bad at this by and large, right? And we know this from behavioral economics. And it's related subsection of this behavioral finance, which is becoming an increasingly big part of the way that people study finance. And so the insight here is that people are not rational, perfectly rational. That people are predictably irrational. They're not completely irrational, but we tend to be irrational in predictable ways. Now, this is an idea that's been in economics for a long time, right? Some of you will remember from Principles where we talked about John Maynard Keynes and his theories of business cycles, and he talked about something called animal spirits. This idea that we have this psychology in us that makes us very prone to booms and busts, to excessive optimism and then depression. We tend to overreact. And Keynes has a good explanation for why this is. Keynes said we're all connected via our psychology. Okay, and the analogy he uses, which is, I think, an excellent one, is the beauty contest. Okay, so he likened picking a stock to picking the winner of a beauty contest. So let's say you're going to pick the winner of the beauty contest. Should you pick the person that you think is most beautiful? No. How do you pick the winner of a beauty contest? You have to think about who other people think are the most beautiful, right? And that's the same with the stock. You're not always picking which stock you think is the best. You're picking stocks that you think other people think are the best. So when you think about that, it's really an expectation of an expectation that is often not based on much information or fact. And so this is why Keynes thought that we were prone to boom and bust and very sensitive to psychology. Now, the thing about Keynes was that he was very insightful, but he was not a psychologist, right? He had some, now Keynes himself actually was a millionaire and he made money speculating on financial markets. So he had a good intuitive view about how financial markets work, but he didn't really have I wouldn't say a scientific view or an explanation for why. Now, one of the things we've had here over the last 20 years is the work of two psychologists who actually won the Nobel Prize in economics, Kahneman and Tversky. And they have essentially become the fathers of behavioral economics. And what Kahneman and Tversky have done is they've explained why we are so susceptible to making bad decisions. And the whole, it really all gets down to this fact that we are literally of two minds. We think about everything in two different ways. And Kahneman and Tversky call this type 1 and type 2 mind. The type 2 mind is the rational mind. This is the mind that economists like to think that we think with all the time. Okay? So the type 2 mind is the rational mind that weighs costs and benefits. However, what's the problem with using the type 2 mind all the time? How many decisions do we make every day? A lot. Thousands, hundreds of thousands, maybe millions. If we had to do cost-benefit analysis on every decision that we had to make, we would be paralyzed, right? It's very costly to think about this, right? So from an evolutionary perspective, thinking about everything with our type 2 brain doesn't make any sense. Our brains used about 30% of our energy. Brains are extremely costly from an evolutionary perspective. And so we need to figure out ways that we don't use our brains as much. And that is exactly what type 1 thinking is, right? Type 1 thinking is you would call passive thinking. Instinctual. And most importantly, it relies heavily on what are called heuristics. And heuristics are just essentially rules of thumb. We make a lot of decisions using rules of thumb. But one of the things that we know is that these rules of thumb are really bad. They're really bad. We tend to make crazy decisions in predictable ways. And why do we do this? Because it's cheap and easy to do it, right? It's cheap and easy. But as a result, we tend to be predictably wrong. So let's think about some of these heuristics that often impact stocks, right? And as we talk about these, it's really a ways to think about all the traps that people fall into when they make investment decisions. And so I'm just going to talk about 8 or 10 things here, but there's many, many sorts of heuristics or biases that people fall into. One is what's called the loss aversion bias. And this is pretty simple. We weigh losses more than gains. So using simple experiments, this has been shown to be true multiple times. When somebody picks a stock and it goes up by 10%, we are not nearly as happy as we are sad when a stock goes down by 10%. So what does this mean? We spend a lot more time avoiding losses than we do looking for gains. So for instance, one of the things that is hardest for investors to do is take a loss. Actually, speaking for, I have some friends who work on Wall Street. I'll actually say that's probably one of the key mindsets of being successful on Wall Street, is people on Wall Street know how to take a loss, right? When they have a loss, they're like, okay, I'm taking it, I'm moving on. right? That is the hardest thing for most people to do, right? We have such an aversion to taking a loss that we stick with things way too long, right? Likewise, this is related to ownership bias. What do we tend to value more, the stock we don't own or the stock we do own? We tend to value more the stock we own, right? Listen, these biases don't just take place for finance. They apply to a whole range of decisions that people make. In the sporting world, I'm sorry for using too many sports analogies, but in the sporting world, been lots of studies that suggest that where general managers make predictable mistakes is ownership bias. They tend to overstate the value of their own players, and they tend to understate the value of other players. Right? And so one of the ways that general managers become better over time is actually figuring out ways that they can actually effectively value their own players, right? Because you tend to value the things you own too much. Availability bias. We tend to rely on easy information. When we talk about availability bias can be even information that is completely irrelevant. So one of the experiments that Kamen and Tversky ran, we actually ran on the first year students last block, okay? So first year students, we actually read a few chapters from Kahneman's book. And so we actually pulled one of these experiments on the first year students, and it worked beautifully. And this is the experiment we did. We told them, we didn't do this in person, we did this online, but they got online and they spun a roulette wheel. And they saw what the roulette wheel landed on, and then they were going to report that number. And then they went to a next screen, and the next screen said, what percentage of the countries in the United Nations are from Africa? Most people have no idea, they just have to make a guess. So they make a guess. Well, here's what we didn't tell them. The roulette wheel was rigged, and it only came up with 65 or 25. That was the only two numbers you could get. But here's the interesting thing. The people who saw 65, what did they bet about the percentage of countries in the UN that were from Africa? Much higher numbers, closer to 65%. And what about the people who saw 25%? Much lower numbers, closer to 25%. Why? Does that make any sense? Of course not, but that's how our brains work, right? We essentially get anchored by things. Irrelevant information anchors our thinking, right? So all the time this happens. This is classic in negotiation, right? I take students to China every couple of years, and bartering there is pretty common. And oftentimes people will start out with a price that is 3-4 times what they end up with. And students will say, oh man, why do they start at 3 times, right? I mean, they know we're gonna go down. Why don't we just save the hassle? Well, yeah, they know you're gonna go down, but they know that if they start at 3 times, you're not gonna go all the way down, right? Because you get anchored. And they know that Westerners are particularly susceptible to this, right? Because if you grow up in a culture of bartering, you kind of know this, right? You realize that there's this availability bias. But Westerners aren't as cognizant of it, and so they get us all the time with that kind of stuff, right? So just another example. I mean, we can keep on going on and on. Some of these you just won't be surprised by, because you know, either through your own behavior or through other people's behavior, you've seen people fall into this trap. We often believe we predicted things that we didn't. We like to tell stories of causation, how we knew things were going to happen. So here's a great example. This is actually an example from Kahneman and Tversky's book. So the interesting thing about Kahneman and Tversky is they actually met in the Israeli Air Force. Right? They're both Israelis. They were both psychologists, but they both got drafted, and they were both working in the Air Force. And one of the things they noticed when they talked to commanders is commanders would say, I am never going to say anything good to my pilots again. Because every time I compliment them, they do worse. And every time I yell at them, they do better. And Kahneman thought about that for a second and said, you are a victim of hindsight bias. Why? Every time they got complimented, what did that mean? They did something well. But what happens if they didn't do something well because of causation, but because of random behavior? What's going to happen the next time? They'll do worse. And so the commander draws from that the fact that next time they do worse, it must be because I yelled at them, not because it's random occurrence, right? And that's what we tend to do, right? We tend to tell stories about causation, right? We tend to tell stories about causation, right? Here's another classic one. Smart women tend to marry men who are not as smart as them. Why? I know where your brain went. Your brain is like, well, smart women, they probably, make lifestyle choices. And no, it's just simple probability. If you're smart, you're likely to marry somebody who's not as smart as you, period, right? It's not a causation thing. It's just simple statistics. And so, once again, we tell stories, right? And this happens all the time in stock markets. People say, oh, I bought the stock and it did really well, right? Let me tell you about how smart I am. Well, chances are it was just random luck, right? Random luck. Related to this is what's called conjunction bias. We tend to think that unrelated events are related. I might have to say this. We think unrelated events, right? Everybody knows this in sports. Once again, I keep on talking about sports, but wearing the lucky jersey or the lucky shorts, right? That's kind of an egregious example of the ways that we, once again, tend to portray causation all the time. Our brains want to find causation when oftentimes it's just random luck. Talking about sports, this whole idea of the hot hand, which is something that everybody who's played sports or watches sports tends to believe. This fact that people get hot. And when they get hot, you should feed them the ball, right? If you're playing basketball, you feed them the ball. But if you actually look at the data, if somebody's made 6 shots in a row, what's their chance of making the 7th shot? It's what it always has been for that player, right? It's just random occurrence, right? It's just random occurrence. Confirmation bias. I'm not going to talk about any. I'm going to start right here. Okay. You can't talk about politics anymore without talking about confirmation bias. because basically what's true? People tend to pick facts that already agree with what they think, right? We tend to look for information that confirms what we want to believe. So we are not unbiased purveyors of information. We tend to pick and choose information that's consistent with the things that we already believe. All right, so, listen, I could keep on going on and on here. I'll kind of leave it at this. I highly recommend reading Daniel Kahneman's book called Thinking Fast, Thinking Slow, right? Thinking fast is kind of type 1 thinking, and thinking slow is type 2 thinking. It's a great book, and it's actually very, very readable because really most of the book is just all these clever experiments that they have done over the years to kind of show that these biases that maybe you suspect people have, they have. And so a lot of behavioral finance is really driven some of that quant fund stuff, right? As we become more and more convinced that we're not particularly good purveyors or users of information, maybe machines can do better. I'm not sure if that's exactly the conclusion I would draw. Because machines might have their own biases. I think that this stuff is really important because whenever you make a decision, you should be self-reflective. And so, I'll just say for myself, over the years, having become very familiar with this stuff, I think it's helped me because when I make a decision, I stop back and I think, am I really being rational about this? Am I considering all information, or am I believing what I want to believe, right? Am I relying only on current information, right? Am I really am I being critical about my own thinking, right? Understanding this is crucial to being a critical thinker about your thinking. And so, that's a great ability to have if you ever go work in a financial market, right? Because you have all this information, we're making a lot of decisions, but I think the people in general who are good about it can be critical about their own thinking. They think about their own thinking, right? As opposed to just making decisions, they think about how exactly did I come to that decision, right? Some of this psychology definitely plays roles in asset bubbles. And then the flip side, which is stock market crashes. What's an asset bubble? When a price is greater than what can be justified by the fundamentals. Okay. When prices get above what can be justified by fundamentals. Asset bubbles have been common throughout history, right? Not just in stock markets, but in many different types of markets. Some of you might be familiar with tulip mania, right? Have you ever heard of tulip mania? So tulip mania took place in Amsterdam in the 1600s, where tulips were selling at basically, what is it, like 10,000 times average annual income of an individual in Amsterdam, right? Tulip prices went up by 6,000% in 1 year, right? Only to crash and leave many, many people bankrupt, right? And since then, we've had asset bubbles in housing, right? We had one pretty clearly in 2008, right? Or the buildup to 2008, where prices got many, many more times what you would expect, what could be justified by fundamentals in many areas, right? And then stock markets. We know that stock markets get frothy, right? They get bubbly, right? Where the prices go way up, and then oftentimes that process turns around and drops. And so let's think about why these happen. And there's really kind of two big theories. One is beliefs. And psychology. And these theories really kind of focus on a number of psychological things that we're vulnerable to. Some of these things that we talked about here a couple of minutes ago. The fact that we tend to be vulnerable to manias and panics. What we tend to see during bubbles is what you can call the greater fool strategy. You familiar with the greater fool strategy? The greater fool strategy is, why should I overpay for this stock? Because there's somebody even stupider out there who will buy it from me, right? And that kind of thinking often pervades bubbles, right? I'm sure I will tell you this story later in the class because I often repeat myself, but I will know that I knew when there was a housing bubble in the United States, and it was in 2007 when I sat down to Thanksgiving dinner with my idiot uncle, right? Everyone's got one, right? I got an uncle who is an idiot, and he spent most of the dinner talking to me about all the money that he was making flipping houses in Florida. And I stood there with my jaw kind of dropped. And I said, he showed me some pictures. And I was like, you mean that you paid $200,000 for that house? How can you do that? And he said, don't worry. There's somebody else out there that will buy it at $250 from me in 6 months. I know there is. And that just rang bells for me, right? Because that is the classic greater fool theory of investing. There's nothing about fundamentals there. Nothing about what the house is really worth or how much it costs to build the house or the value of the land or what's happening in the economy. It's just there's somebody else stupider than me. And so you tend to get that, right? You tend to get that. Related to that, you get the this time it's different. Thinking. What's this time it's different? There's an old saying in finance that the most expensive words in finance are this time it's different, right? So when you begin to hear people say, oh, but this time it's different, you should be worried, right? Because usually we see these things play out again and again and again. And so there's been many, many theories that kind of focus on the psychology, right? And some of this stuff is understandable because as we think back to the Keynes Beauty Contest, right? Psychology does play a role in stock markets. It's got to, because you're often thinking about not what you think, but what other people think. And so that that kind of leads to this greater fool strategy, or this time is different. Or also, this encourages a lot of herding behavior, which can also be psychologically driven. Herding means you just follow what other people are doing, in part because you think they know more than you do. So everybody buys, you're like, well, I don't know, but these smart people are buying, so I'll buy. And then other people sell, and you're like, well, I don't know, but these smart people, maybe they know something I don't, and they begin to sell. So that's one big group of theories, and I think there's obviously a lot to be said for these. Having said that, I think there also is a lot to be said for fundamentals. And fundamentals related to moral hazard. What we often see leading up to a bubble is what we can call debt finance speculation. Debt finance speculation. Meaning people borrow money and speculate with it. And what do they tend to do? Risky things. How can they justify doing these risky things? Well, because they're using other people's money, right? And that's what moral hazard is. When you use somebody else's money, it encourages you to engage in risky behavior, right? Oftentimes, bubbles are preceded by financial deregulation. When the government pays little attention to what's going on, and so people begin to engage in very risky behavior, in part because of moral hazard. So, when we talk about the 2008 financial crisis, I'm going to come back and talk a lot about this, but clearly one of the things that drove this, it wasn't just psychology. There were fundamentals involved, right? There was clearly a lot of moral hazard, and it was set up in the way that the system was set up, right? So, one of the ways that this all happened, right? How was it that people that had no income and no job were able to qualify for a loan? Well, part of the reason it happened is that you had people that their basic job was what was called mortgage originators. They would go out and find people and give them a mortgage, and then what did they do once they had the mortgage? They turn around and sell it to somebody else. And their thinking was, why do I care if this person ever pays it back or not? I'm just going to turn it around and sell it, right? So I don't care. I'm not going to do the paperwork. I'm going to help originate a mortgage for the riskiest person I can find. Doesn't make any difference. I'm just turning it around and selling it, right? And then why did the people buy it? Why did the investment banks buy it? Well, their thinking was, yeah, it's true. Some of these mortgages are risky, but look how many we have, right? Look at the value of diversification. We have 100,000 mortgages. Well, you know what? There's only some risk you can diversify away. You can diversify idiosyncratic risk, but systematic risk, you can't. And so there were so many bad loans issued, right, because of moral hazard, that the whole system was set up to fail, right? And so that often happens, is you just get these big blow up in credit where people start lending money, it starts fueling speculation, and before you know it, you have a bubble. And so I don't want to say that these things are mutually exclusive. I think in many cases, they kind of feed on each other, right? The psychology feeds on the fundamentals until asset prices get so high that something happens and there's a pop. And when there's a pop, usually there's a pretty big drop, right? And so it has not been uncommon to see, for instance, in stock markets, declines of 40 to 50%. 2008, we had a 40% decline in the stock market, right? And that obviously plays a huge role in destroying wealth, right? And as we're going to talk about a little bit more later when we talk about the 2008 financial crisis, it destroyed banks because banks are not set up to take losses. Their basic structure is one that does not give them very much flexibility to take many losses. And so once banks started to take even a little bit of losses, they became fundamentally insolvent. And the whole system basically collapsed on itself in a vicious circle. And so, yeah, you know, this is really one of the things that we have to think about. I'll end here by just talking a little bit about an example that you guys don't remember very much about. You don't remember at all because you weren't alive. But the dot-com bubble of the 1990s, 1991, right? So some of these are really funny, right? In some sense. Like Tulip Mania, it's kind of funny that people were paying, you know, thousands of dollars to buy tulip bulbs. Well, that's kind of what happened in the late 90s, right? So the late 90s were really the beginning of information technology, right? People were getting computers and email was taking off. And basically, up till the late 1990s, this would be hard for you to believe, you had to physically go to a store to buy something. It was horrible, right? It was horrible. But beginning in the late 90s, there were some stores that started to pop up online to sell you stuff, right? So there were companies like Pets.com, all right, that sold pet supplies. And so in this time in which the economy was rapidly changing, valuations of these dot-coms, as they were known then, right, rose dramatically. So the NASDAQ, which has always been a technology-intensive index, it basically rose by 720% during the 1990s, or sorry, the late 1990s, right? It doubled in size in 1999 alone, right? So a huge bubble. Pets.com, okay, which went public in 2000, saw its stock price rise from $1 to $14 in basically the course of a year, right? What was their market? Selling online pet supplies, right? They basically had $1 billion valuation for selling online pet supplies, something that pretty much anybody could do, right? I mean, it was kind of crazy, right? And so what happened in 2000 and 2001 was, for reasons, honestly, that even in hindsight are not completely clear, the market just started going down. And I think where there was a wake-up call or whether the greater fools ran out, people began to get very worried about these overvaluations. Pets.com went from $14 back to $1, right, in just a couple of months. And then it ended up going out of business, right, in November of that year. And so, you know, when you look back at examples like this, you kind of see all the things that we've talked about this week. First off, the lack of information and asymmetric information, right? People didn't really know much about these dot-coms, right? But some people got excessively optimistic about it and, you know, kind of led to this bubble. We know that there was moral hazard behavior, right? A lot of these dot-coms basically kind of were able to get all of this, you know, huge speculation money, in part because banks were lending to them, right? Banks were lending to them. There were the biases that we talked about in behavioral finance, right? Such as confirmation bias, looking only for information that confirms what you already believe, and ownership bias, overvaluing stocks that you already own. There was a lot of greater fool thinking, and this time it's different, right? This time it's different. We'll say this again and again because this tends, usually when we see asset bubbles or financial crises, there's something in there in which people say, yeah, but this time it's different, right? And so during the dot-com bubble, it was like, well, this time it's different because look at this. I can send an email and buy some dog food. That's just fundamentally changed my life, right? And so sure, this is worth $1 billion, even though it's really just, you know, an address, an internet address. And so it's just an example of how these things can happen, right? And so as an economist or as somebody who's kind of a rational thinker about finance, I will say you have to live, when you think about stock markets or really any sort of financial market, you do have to kind of live in this world of two minds. You have to use your system 1 or system 2 brain, right? Your rational brain, and understand that by and large, markets are efficient because they are very rational. But does that mean that markets all the time are efficient or rational? No. That there are examples where we're vulnerable to biases. Maybe that's going to become less so in the future as machines begin trading, or maybe machines will kind of figure out their own kind of biases, right? Yeah, I mean, one of the things about machine learning that I should have said earlier is a lot of machine trading is just a black box to us humans. We don't really even understand why computers are making these decisions that they are. And that's kind of scary, right? When computers are making billions of dollars of trades and that we don't really quite, many of the institutions themselves don't really quite understand why the trades are being made. So anyway, I still think that for most people, thinking about the market as the efficient market hypothesis and following that investment strategy that we talked about is the best way to go, right? Buy and hold, put your money in index funds, don't listen to don't listen to investment managers, right? For most people, that's the same. But, it's hard to argue that markets are always perfectly effective, right? Because we know that there are these biases out there. All right, well, I think that's all I want to cover today. So anybody have any questions about anything related to the stock market? So beginning on Monday, we're going to change gears a little bit and we're going to begin talking about banks. Okay, so first week is kind of financial markets. Next week is going to be mainly about banks. All right, so that will be the topic of conversation come Monday. So we'll also talk about your second exam, all right? First exam. And then I'll also give you back your first homework. We can go over that. We'll talk a little bit about second homework if you have any questions, all right? Okay, have a great weekend.